So today I'll be talking about 5 shortcuts to crypto investing. I did originally call this 5 shortcuts to successful crypto investing, but our compliance team told me to water it down a little bit. There's obviously no guarantees or no success in this game. A lot of people want to have Can you hear that okay? Is that any better? Yeah, okay. So before we go any further, I'll just run through a quick risk warning from our compliance team. Now, please don't take this as investment advice. Don't rush out and do a trade on real money immediately after speaking here. By all means, do one on our demo account. But as I'm sure you're aware, trading cryptocurrencies can be very risky. So it's important to manage your risk and have the right risk management procedures in place. So there's 3 main things that I really want to talk about, which define and are slightly different when you trade cryptocurrency CFDs to traditional CFDs. So we also offer CFDs in many other markets, FX, commodities, indices, for instance. These 3 characteristics really are something worth noting if you are trading cryptocurrency CFDs. First off is the price volatility. These markets are far more volatile than your traditional market classes, so you should be aware of that when you're trading and position your size accordingly. Secondly, there's leverage. There is leverage on other markets, but trading cryptocurrency CFDs with us is different to trading a cryptocurrency on an exchange where you typically have no leverage. Now, leverage can be a fantastic tool if you use it correctly, and it can magnify your profits. But if you use it incorrectly and you don't trade using the appropriate risk measures, you can also lose money quickly. So it's very important to understand the risks associated with this. Finally, there's also charges and fees you should be aware of. There's no commissions to trade cryptocurrencies with us, but one of the costs implied in trading is the spread. So that's the difference between the bid and the ask price, which is what you can sell and what you can buy at. Now, the spreads are typically wider in cryptocurrencies compared to traditional forex pairs such as euro, US dollar, and this is simply a reflection of the underlying market. So that's another consideration to base your trading strategy on, and something to also bear in mind when trading cryptocurrencies. Now, this is just a slide to explain how we take our prices for our cryptocurrency CFDs. So if we look at Bitcoin, for instance, you can see we've got Bitstamp, GDAX, and Gemini, and essentially what we do is take a weighted average from those 3 exchanges. So if you do look at the Bitcoin price somewhere else and you see a different price to the price that we're quoting, that's probably because there's a difference in our calculation here. So that doesn't necessarily mean our price is right or the other price is right. It's just how we arrive at our price is a calculation of an average from these 3 exchanges. As I'm sure anyone's aware who's looked at several crypto exchanges, there can be quite big fluctuations and different prices at the same time on different exchanges. So the instruments that we offer, there are 5 cryptocurrency CFDs that we provide. So you can trade Bitcoin, Ethereum, Ripple, Litecoin, or Dash. All of these CFDs have 5-to-1 leverage, meaning that your deposit that you need is only 1/5 of the total position size, and the markets are open nearly 24/7. So they close Friday at 9 p.m. and we open at 3 a.m. on Saturday. So almost 24/7, but not quite. For the trading competition, by the way, that began today and that will close Friday 9 p.m. So what are these 5 shortcuts? First off, I think very important when you're trading any market to know the fundamentals associated with the market. So it's important to keep abreast of the latest developments, particularly if you're trading in a fairly short time horizon. So knowing your fundamentals is key. The second one, and I think hopefully this is what I'll base most of this presentation on, where you guys can get the most value, is using technical analysis when you're trading. So I'll talk about using technical analysis. What this allows you to do is be precise with your entries and your exits, and also identify asymmetric risk-reward opportunities. That is a real key and often overlooked aspect of successful trading. The next 2 things to look at really come from the technical analysis itself. So, like I say, clearly identify your risk before entering a trade, especially when using leverage. This is very important. And also look to assign profit targets and places you're aiming for during the trade. Finally, I'll talk about leverage and how that can magnify your gains if you use it correctly, and also bear in mind it can have a downside if you use the wrong way. So, I couldn't really come up with a more catchy sort of name to describe 3 things to look for in fundamentals than the 3 whats, but whenever I'm looking at a market, there's 3 whats that I ask myself essentially as a question. First off, what is the current situation? What's driving the market at the moment? What is the market focusing on? Now, this is the same whether it's an FX pair, whether it's a commodity, whether it's a stock. You need to be aware of what's happening with the actual market itself. Also be aware of what could potentially happen in the future. So look forward and you can see potential regulation, for instance, cryptocurrency, which could be a big thing to look out for in the future. And then finally, the most important is what impact these fundamentals have on the market. You can have instances where the price reveals something stronger. So for instance, when we had the fork, the software upgrade with SegWit2x, which was proposed to happen in November, when this didn't happen for Bitcoin, we saw the price drop initially, but then it actually recovered and went far higher. Now, it's a very strong signal if the market doesn't drop on what is effectively bad news for it. So the way the market reacts and the price action is always key. So 2 examples, this is of fundamentals at the moment for Bitcoin. There is some suggestion that the interest in Bitcoin itself is dropping and in decline. This is a chart showing the average transactions per day carried out in Bitcoin over the last year. You can see we averaged around 250, 300,000 for large parts. We had a spike of interest towards December, around the time Bitcoin hit an all-time high, around 19,000. You can see in the last month or two, we've had a huge drop-off in the number of transactions. What this tells me is the widespread adoption that was clearly being priced into Bitcoin hasn't quite happened yet, and this could lead to further downside in the Bitcoin price going forward. Now, this is a chart comparing the number of transactions or the transactional volume and the Bitcoin price. Look in particular from June last year to around December, and you can see we had a fairly strong correlation. So the Bitcoin price is the blue line, and then the price is the blue line, I beg your pardon, and the transactions is the white line. You can see we had that strong correlation where price was rising as the number of transactions was also increasing, but we've had this major drop-off in transactions lately, which could be seen as a negative for the Bitcoin price. Also, if you look in terms of internet searches, so if you look at Google and the number of people who are searching Bitcoin, you can see again we've had a decline in interest recently. You can see going back, both of these were very low. This is indexed to 100, so 100 is the most number of Google searches we ever had. Again, this peaked around December time when the market was soaring higher. A lot of people wanted to get into Bitcoin. A lot of people would find out what Bitcoin was. A lot of people wanted to buy Bitcoin. Recently, we've had a very sharp decline. Currently seeing around a third of the number of Google searches that we had back in the December peak. So there's not the same level of interest on the internet for Bitcoin. Now, this isn't necessarily reflective of cryptocurrencies in general. I'm speaking specifically about Bitcoin here. Now, another fundamental development for Bitcoin that I want people to be aware of is the Tokyo whale. So one of the reasons behind Bitcoin's rise last year was the idea that there was a lot of whales in the market, and by a whale I mean a very large player who has a large Bitcoin holding, and they essentially were holding their Bitcoin whatever. They weren't selling out, so you had these large players behind the long side. Anyone that knows what happened to Mt. Gox was the world's most popular cryptocurrency exchange in 2014. It went bankrupt. It used to account for around 70% of global Bitcoin transactions, and it went bankrupt, and there was 850,000 Bitcoins lost. The market value of these Bitcoins at the time was around 500 million. At present, it'd be around 8.5 billion. So this is a lot. This is a major deal in the market. 200,000 of those have subsequently been recovered, but there's still 650,000 missing, and that haven't been found. Now, the Tokyo whale is essentially the Mt. Gox bankruptcy trustee who's managed to recover some of these Bitcoin. And they've basically been selling large amounts of Bitcoin lately, trying to get money back for people who lost money through the cryptocurrency exchange going bankrupt. So what you're getting is a big player essentially who's selling into the market, and this has been really weighing on price. So why this is important is it goes against the notion, like I said, that all the whales and all the big players in the market are on the long side. I'm sure you're aware of people like the Winklevoss twins and several other obvious anonymous investors who hold large portions of Bitcoin who have said that they won't be selling. Now, this is a chart that I took from the middle of last year, so the numbers have probably changed slightly. At the time, there was 16.3 million Bitcoin in circulation. There's currently around 16.9 million, I believe. But what I want to show here really is the percentage of lost Bitcoin. So if a Bitcoin is lost, it is essentially taken out of circulation. This can happen several ways. This can happen if someone forgets their login credentials and can't get back to access their Bitcoin. It could also happen if there's a Bitcoin holder who has a large stake, potentially the founder himself or herself, Satoshi Nakamoto, if they've since passed away and not passed on those Bitcoin to anyone else. So the idea behind this is essentially that out of those 16.3 million, around 3.7, 3.8 million Bitcoin are out of circulation. If you look at the out of circulation or hodlers, a hodler is a hold on for dear lifer. So essentially, like I say, those big whales who wouldn't exit Bitcoin no matter what's happening, these were seen as sort of having the backs of the longs in the market. So you would think if there's these big players who are never going to sell Bitcoin, there's a large portion of potential selling pressure that will never come to market. The Tokyo whale and the recent selling we've seen there, while smaller than this in scale, is a fairly sizable person or entity that is selling the markets. That's a negative development for Bitcoin. You can see here a chart of the Bitcoin price going back to the start of 2017 when we were trading below $1,000. Like I say, it peaked at just shy of 20,000 in December, and we've since fallen back. Now, this announcement about the Tokyo whale selling their holdings, $400 million worth since around October, came out just last week. But the worry is that there'll be more of this large-scale selling to go going forward. And obviously, the seller is trying to get the best price they can. So any rise that you see, if you see the Bitcoin price start to rally again, then you could be met with another wave of selling, and it essentially put a ceiling on the market. Now, whilst fundamental analysis is what typically drives the market, it's quite hard to trade purely on the fundamentals, especially if you're using leverage. So what I use is technical analysis to essentially hone your entries and your exits and to manage your risk. Now, I've got a quote here from Stanley Druckenmiller, who's one of the most famous, successful hedge fund managers of all time, multi-billionaire. And what he's essentially saying, I won't bore you by reading the whole quote, is that he doesn't use fundamentals to control his timing of the market. He has a fundamental bias, and then he uses technical analysis to look for entries. So, for instance, let's say if you're fundamentally bearish on the price of Bitcoin, because of those reasons I've explained previously, you could look for some sort of sell signal from technical analysis point of view to enter a short position. Now, it's another important differentiation to make with CFDs to traditional buy and hold investing in cryptocurrencies. You can also take short positions where you look to profit from the price falling, as well as buying to look for the price to rise. What technical analysis can and can't do is very important to know, and it's important to be aware of this. Now, technical analysis can't accurately predict the future. Sometimes people will make predictions, they'll be right, but no, it's no magic ball. It's not like you can see exactly what will happen and say price will go exactly to this point in time. What technical analysis does allow you to do is to identify the path of least resistance. It also allows you to select asymmetric risk-reward opportunities, and I'll come back to this in more detail when I talk about your risk management. And finally, it allows you to precisely manage your risk, which I think for any successful trader or investor is a very important thing. So one of the most simple technical analysis tools you can use is what I call support and resistance. Support is simply an area where the market has previously come down to, and it's found buyers defend it. So if we look back to the left-hand side of this chart, around the end of last year, you can see at 12,800, there were several occasions the market fell down to this level and buyers stepped in and could defend this level. Now, once you have a support broken, as we got with that large decline, I think it was the 23rd of December, just before Christmas, when we got the flush and the breakdown free, and that major decline of around 20% in the day, don't delete your support line off the chart. Keep that there as a reference point, and that may then in the future become resistance. Lo and behold, you can see 5 or 6 days later, that very same level, the market retested from below, and this time, rather than finding buyers stepping in there, sellers stepped in and defended this level. The market fell back down and made another low around 10,100. You can see it found support there before breaking down lower. Now, support and resistance is never 100%. You're never sure where the market is going to turn. But if you want to identify precise entries and exits, it's important to have some sort of reference point from where you can trade off. So this is a trade example I highlighted from just in the last week. So this is now what I call a 4-hour candlestick chart of Bitcoin, and I'll just talk you through how you could look to trade it. If we look at that 11,800 level as a possible longer term resistance zone, what you can do then is use shorter time frames such as 4 hourly to look for how the market's reacting. Any signs that sellers are looking to defend it again, then you can look to enter a trade. So if you can see this level here, well circled, the market rallied back into 11,725, and then we had a red candlestick. A red candle essentially means it closed lower than where it opened, which is a sign of selling pressure. So if you were to take a short 11,500, what you want to do when you enter the short is to place a stop loss. Now, the easiest way to think about where you place a stop loss, I always ask myself, what is the reason I'm in this trade, and what would have to happen to prove me wrong? So what's the reason I'm in this trade? Quite simple. I think there's potential resistance around 11,800. What would prove me wrong that there isn't resistance at 11,800? Simply price breaking up through 11,800. So I'd have a stop loss at 11,830. You can see that is a risk of 330 ticks. So if you're trading one contract or one lot, that's $330. And then in terms of take profit, I'd look down below to find a support level. You can see I had this support level around 9345. I didn't want to expect it to go all the way to 9345, so let's say 9,500 I had as a take profit. And that is basically $2,000 I was looking for on the downside. Now, the key to this setup and to trading in this sort of way is the asymmetric risk and reward. What you can see here is you're only risking $1 to make 6. You're essentially risking 330 and looking to make 2,000. What this means when you have the risk reward skewed in your favor like that is you don't need to have a very successful hit rate to be a profitable trader. To put another way, you can have a fairly bad hit rate and you still won't lose money. I'll show you some examples of this more later on. Now, another technical analysis tool that I think is really good and really effective in terms of trading the markets is from classical charting. It's called head and shoulders. So a head and shoulders pattern is basically a reversal pattern and it occurs after a trend. So I showed you earlier, Bitcoin trended higher for most of last year. And if you look on the left-hand side of the screen, you can see we surged higher and we made the first high around 15,500 to 16,000. That's your first shoulder. The second part of the setup is the market goes above this shoulder and makes a new high. That is the head. Then the third part of this setup is the market pulls back again, attempts to go higher, but crucially doesn't go above the head. So the second shoulder you can see form there around 17,400. Now the shoulders themselves aren't that important in this setup. The key things to look for is the head itself, which is easy to identify as the peak. If the market goes above the head, it's obviously no longer a head. And then what you need to look for is some sort of support below. Now, if you want to trade off the back of this, what you look for is a breakout below that support and then to enter short. As I said, it's a reversal pattern. So I found some potential support around 12,750. You can see after the head, we dropped down, tested that, found buying support. Several occasions in the days afterwards, we also found support around that level. So what I was looking for was a break below 12,750 to trigger this trade. Now, you can trade this by looking to jump in as soon as the market breaks through this price. If you want to have higher conviction, then I'd wait for the daily close or the hourly close or whatever time frame you're on. Obviously, the longer you wait to enter the position, you sometimes need to have a wider stop loss because your entry will be at a worse price. So there's always a constant trade-off between how quickly you enter the trade and the higher conviction you have the trade is going to go in your favor. So looking at this trade here, once we break down below 12,750, close below there, the setup was triggered. Now, potential take profit for this trade is taken as the distance from the headline to the neckline. So that's 19,578 at the head, neckline at 12,750. Difference between that is 6,828, and then you project that below the neckline. So if you take 12,750 minus 6,828, you get 5,922. And lo and behold, albeit a while afterwards, the market came down and hit the target almost perfectly at the start of February. Afterwards, what happens, the market bounced, whatever, doesn't matter. But the important thing is that you got that break and you had a nice risk reward. In terms of placing your stop loss, if you enter this trade, what I'd use is called the last candle rule. So I'd have my stop loss above the candle that made the break. So you can see here I've selected 1317.60 and I'd have a stop loss above there after entering here. So you're risking around $1,000 in this trade. Now that's if you trade a one lot at XTB. You can also trade mini lots. You can go down to 0.1 Bitcoin. So therefore you'd only be risking $100. And you're looking to make a profit of 6,828 if it's one lot, or 682.80 cents if it is a mini lot. Now you can also trade inverse head and shoulders. So a head and shoulders after an uptrend, it's a reversal signal and a topping formation. Inverse head and shoulders is a bottoming signal, a potential bottoming signal. Now the neckline doesn't always have to be a horizontal line, it can also be a trend line. A horizontal line is nicer because you can see very clearly when it's broken above it, and also if it breaks above it, it must continue to go higher without negating that. When you have a falling trend line, it's not quite so nice because the market can drop lower but not fall back below that falling trend line. So this is a 4-hourly inverse head and shoulders setup that I had from February. You can see after we made the low, it wasn't actually 5922, I think it was 5867. You can see more precisely on a shorter time frame. And what you look for is the market was obviously trending lower. You had the first shoulder there, around 7,500. The head came in 5867. Second shoulder, where it pulls down 7462. And this purple line is my fall-in neckline. This clean break here, where we've had a strong move higher in close, this time on a 4-hourly, is your entry signal. I'd look to enter long 9137, a stop loss below 8767, which is a risk of, say, 370 if you're trading on a one lot. And your target is taken from 8767 minus 5867, which should give you 2,530. Basically, you can see the market rallied after this. It moved up higher. It came back up towards that 12,000 level, and it hit the target around 11,700 later that month. So now you're probably thinking these are all well and good, but it's easy to select setups that have worked previously. So this is a setup that I was watching all this week, and I was actually looking for an inverse head and shoulders setup to occur. So from here, looking on a long time frame from the all-time high, we had the long move lower. We had this bigger, deeper inverse head and shoulders, with the shoulders coming in around 9,300, that head around 5,900, and this fairly good resistance here around 11,800. You can see we tested on a few occasions. Now, when we were here, I was hoping the market would break above here. If we did break above here, then we could look for a strong move to the upside, because it would be this distance, which is around 6,000, projected above 11,800, so it would take us back near to all-time highs. However, I think what we could have had is a failure of this setup. Now, you can trade inverse head and shoulders or head and shoulders failures by looking for a market to take out a previous low. And once we took this out, I think this was on Thursday, you could get the setup here where you took a short position at 9,205. Your target is taken from the neckline to the head, and then that's calculated, which is, like, say, around 6,000, around 5,900, I think it is, and then 5,773, and then you project that below 9,310 to get 3,332. So again, you've got a very favourable risk reward in this favour. You only need to be right not very often, 1 in 6 times essentially, to break even if you look for these risk reward schemes that are 3, 4, 5, 6 times to 1. We have actually since bounced back a little bit today, and we're still somewhere around here, around 9,300, 9,400. So I just want to explain a little bit more clearly what I mean about with the asymmetric risk reward and when you're trading, what you can look for. This is a quote from Paul Tudor Jones, another very famous billionaire hedge fund manager, and he said what he looks for is 4 to 1 reward to risk. So 4 to 1 means he's risking $1 to make 4. What it means is he has to have only a hit ratio of 20%. In his words, he could be actually a complete imbecile, being wrong 80% of the time on his trades, and he still won't lose money. So if you look at the chart here, if we had a risk reward of 1 to 1, you obviously need 50% hit rate to break even. If you have risk reward 1 to 2, you need 33%, and so on down to 1 to 4. Now, what a lot of new traders do, which is one of the biggest mistakes you can make early on in trading, is to have the incorrect risk reward skew. So what you're actually doing is risking more than you're looking to make as a reward. It goes from one of the classic trading principles, cut your losses early, let the winners run. A lot of people tend to snatch at winning trades and let the losses run. If you have, let's say, for instance, a 3 to 1 risk to reward, in terms of you're risking 3 for just 1 reward, you need to be right on 75% of your trades just to break even. So that's not really where you want to go. From my own personal experience, I trade cryptocurrencies, but also trade other markets. I normally have a hit rate of around 45, 46%, and I look for risk reward in excess of 3 to 1. If you have less than 3 to 1, I don't really find the trade attractive. And as you can appreciate, if you have 45% hit rate, 3 to 1 reward to risk ratio, then you will be profitable over time. Now, finally, I just want to talk about trading on margin, and just to make this point a little bit more clear in case anyone's unaware of it or the consequences that it can have on your trading. Trading on margin is a double-edged sword. If you're successful, it will magnify your profits, it will make you a more profitable trader, it will allow you to grow your account more quickly. However, if you are unsuccessful and you are a losing trader, you'll have larger losses more quickly as well. So it's important to bear this in mind when trading on margin. So at XTB, we provide 5 times leverage, meaning you only require 20% of position value to take a trade. So for instance, if you want to trade one lot, long or short, in Bitcoin, and let's say the Bitcoin price is 10,000, just to make the maths a little bit more simple, you'd only need to have $2,000 in your account to take that trade. Now, a margin call, that occurs if you get into a trade and the trade goes against you. So let's say, for instance, you bought the market at 10,000 with one lot, with just 2,000 in your account. If your account balance goes down to 30% of your margin requirement, you'll be closed out in what's called a margin call. So if the market moves $1,400 against you, so if you buy 10,000, it drops to 8,600, then you'd receive a margin call and you'd be taken out of the trade with $600 left in your account. On the other hand, if you buy the market at 10,000 and it rises up to 2,000, you'll have already doubled your account. You'll have made 2,000 profit on the 2,000. So you can see how, even though the underlying market's only risen 20%, you've actually doubled your account due to the leverage. So if used correctly, it can really benefit you and can make it a lot easier to trade profitably. I was saying earlier when I was on the panel in the other room, we saw a huge move in Ripple just before Christmas where the market rallied more than 10 times. At the time, we were offering 20 times leverage, and there's several clients who made 200 times plus return on their margin in the space of just over a week. So you can see how if you get these right, it can be very profitable, but it's important to manage that and always look to have a stop loss to manage your risk if the trade goes against you. No trader, no matter how good you are, is going to ever have a 100% hit rate. You're never going to be right. If you have got a 100% hit rate, it either means you're very new and quite inexperienced to trading, or you're not entirely truthful. No trade in reality has a 100% success rate. Even if you look at very famous, successful investors like Warren Buffett who take a huge long-term approach, Warren Buffett's had several big losses in his investments throughout his career. So there's final thing I just want to point out as well is sometimes people associate trading with being more risky than investing because of its short-term nature, and obviously with margin people can think this even more so. If you trade correctly, and by correctly I mean only risk 3, 4, 5% of your account on each trade, trading can actually be a very low-risk occupation, and that's what you should really aspire to if you look to trade and look to be profitable. If you invest in a market and you see 80, 90% drops and you have no stop loss, you're risking 80 or 90% of your investment just on that position. So investing isn't necessarily safe, trading isn't necessarily risky, it's how you go about both styles of managing your money. This is a quote from Charlie Lee, the founder of Litecoin, which he tweeted back in December, shortly before he announced he'd sold his entire Litecoin holding. Saying, okay, sorry to spoil the party, but he needs to rein the excitement in. Buying Litecoin is extremely risky. Expects us to have a multi-year bear market like the one he had, where Litecoin dropped 90% in value. So if you can't handle Litecoin dropping 20, don't buy. Now, if you're trading Litecoin, you'd never sit through Litecoin dropping 90% in value. One, because you'd be margin call, but two, you shouldn't be letting it go that far. If the market starts to turn against you, if your entry signal, whatever that is, a support level, a neckline, an inverse head and shoulders, many other things, MACD, moving averages, whatever your entry signal is, once that's invalidated, you should no longer be long that market. So you shouldn't be risking large amounts really when you trade. Vitalik Buterin, who was founder of Ethereum, also said recently, reminder, cryptocurrency is still a new and hyper-volatile asset class, could drop to near zero at any time. Don't put in more money than you can afford to lose. If you're trying to figure out where to store it, he still suggests traditional assets. So again, please don't come away from this with the idea that investing in cryptocurrency is a safe occupation and trading it is risky. If you trade correctly, I believe the risk is actually smaller than if you invest in cryptocurrencies. Thank you very much for your attention. If anyone has any emails, any questions, I beg your pardon, please send an email to here. And please feel free to pick up a trading competition flyer for my colleague Nathan. Thank you very much.
David, thank you very much for that. We do actually have time for 5 minutes of questions if you're willing to take questions.
Yeah.
Does anybody have any questions that they would like to ask David? You'll have to really shout from the back. I'll take the mic.
Sorry?
I'll take the mic.
There is possible slippage on our stop losses, but it happens very, very rarely. The stop loss is essentially an order in the market. So if you're long, your stop loss is in order to sell the market. So when the price goes to that level, your order should be triggered. It should be executed at the best available price. If the market absolutely crashes, there is a chance you do get slippage, but I've not actually personally heard or seen of any clients complaining about slippage on it.
Any more people with questions? I have a quick question.
Yeah, sure.
Do you have any recommendations of online resources one can use to learn to get into this in more depth?
We have some trading packages which are educational based on our platform and through our website, and we also do beginners classes at our offices in Canary Wharf. So if anyone's interested in that, please feel free to drop me an email again and I can arrange that with the account managers.
That's great. Thank you very much, David. Anyone else got any questions?
In your experience, like what is the time frame that you're looking at historically?
What is the what, sorry?
The time frame. How many days behind are you looking?
What's the best time frame to trade?
Yeah.
Because of the spread, because the spread's relatively wide compared to other markets, I don't think it's good for very short time frame trading. So I wouldn't look at 1 minute or 5 minute candlesticks. I personally look for what I call swing trading. So that's, say, anywhere between 1 day to 5 or 6 days normally. So for that, I'd use 1 hour candlesticks or 4 hour candlesticks. And you look for moves, a bit like the support and resistance example I have, moves maybe $1,500, $2,000, something like that, rather than looking for $10,000 or looking for $100.
Just before Christmas, Bitcoin was really high. When it crashed, all the altcoins flew right up. Is that something you're going to expect to happen next time it rises and then it crashes?
Well, I think you need to look at it as the market as a whole. So if you look at total cryptocurrency, you do see they tend to trend together. When Bitcoin's rising, you see a lot of the altcoins rise. When Bitcoin sells hard, you see a lot of the altcoins selling off. It depends really what's driving the market when I was talking about the fundamentals there. If you have something, for instance, there's very strict, stringent regulation that's brought in, which bans ICOs, prohibits cryptocurrency trading in more large economies, then you could see the whole market tank together. If you look individually at them, you also have to look at them, what's happening with each individual market. So Bitcoin, if you look at a market share graph, if you go on coinmarketcap.com, it's a very good graph of Bitcoin, which was always around 90-95% of the market share. Over the last year, despite Bitcoin rallying, it's actually lost around half its market share as altcoins have come up. So on the one hand, you can have the whole crypto space, which will do its thing, and it will go higher or lower. And then you can also have individual movements within there where the crypto space is allocated across different markets. There is regulation coming in. Obviously, China's regulated it. South Korea talked about regulating it. I don't foresee the UK or the US regulating it anytime too soon. But I think whilst that may in the short term be a negative, longer term I think that might actually be positive for the market. If you look at the big institutional money, I think there's still scepticism going into the market when it's unregulated and a lot of it's offshore. So I think if the markets are regulated, then it could actually be positive longer term. Yeah.
Okay, one last question.
Do you have any experience with the altcoin which are covered with decentralized mining coverage, like fiat was covered by, let me say, coin before Nixon cancelled it?
Sorry, I'm not quite sure I understand the question.
If you have any experience with the altcoin which is covered by some vault which is decentralized and have any value, cannot drop down to zero, like Bitcoin.
So you mean if there's an altcoin that's backed by something, a bit like fiat currencies? I do know a little bit about that. I think you always have to treat it with an air of skepticism. Whenever you look at any cryptocurrency itself, you look behind it, what the fundamentals are. I think there is the potential for any cryptocurrency to go to zero. And even when you talk about Tether, for instance, which is supposedly backed by so many US dollars, you don't know for sure that it is actually backed by that many US dollars. So I think it's a little bit dangerous to think there's a floor and the price couldn't go below that. At the same way, it would be silly, I think, to think there's a ceiling for prices at the moment. I think very much we're in a period of sort of price discovery, and it wouldn't surprise me massively if we saw Bitcoin fall back to somewhere as low as, say, $100. On the other hand, it wouldn't surprise me if we saw it go to around 50,000. To trade the markets, I don't think you need to have a very accurate projection or prediction of where it will go in the future to make money. You need to look more for those asymmetric risk rewards where you're playing basically with small risk and you're looking for big rewards.
That's great. Thank you very much, David. A big hand for David. And if you want to find him, he's on stand number 68, which is just out here. So well worth catching up with him if you can and finding out a bit more.